What's going on, guys? Mike Glaspie here at Military Cashflow, and today we're going to talk about how to invest in real estate with the FHA loan. We're going to cover a few different things. What is an FHA loan? Why is it important? What are some of the advantages to it? How do we prep to use it? And then what are the key investment strategies with this specific loan? So without further ado, let's get right to it. All right, so what is an FHA loan? An FHA loan is a government-backed loan from the Federal Housing Administration meant for low to moderate income borrowers. They typically have a lower down payment requirement as well as a lower credit score requirement, okay? So why is it important? Well, wouldn't you like to get a house and spend less money? Absolutely. But more importantly, when we look at a return on our investment, the amount that we get from an investment is relative to the amount that we put in. So the lower amount that we can put in and the higher amount we can receive, that means our return on investment is going to be much higher. So an FHA loan actually provides us that opportunity to put a little money in and potentially receive a higher return on our investment. Now we're going to get into the advantages. And there's two key advantages that we want to focus on. One, we just talked about it, it's the down payment. So the down payment for a typical investment property, okay, is about 20%. That's a pretty big chunk. But when you're looking at homeowner occupied loans, the conventional loans can go up to about 15% at times, sometimes 20%. And there are some that even allow you to purchase a property for 5%. Now that's low, that is low, but an FHA loan beats that. You can actually acquire a property with 3.5% of the purchase price, right? So let's think about that. In a conventional loan for an investment property would be 20%. So if the purchase price was $100,000, that means you would need $20,000 to purchase the property. And that's just the down payment, okay? But in return, let's look at the other side of the coin. If we use an FHA loan, $100,000 purchase price, that means we only need $3,500. That's drastically different. That's a difference of, it's over $15,000. I can't do the math that fast, but you guys know that it's a big difference to either have $3,500 or to have $20,000. So that's advantage number one. Now, advantage number two is that although the FHA loan is typically catered to a first-time home buyer, it is a multi-use loan, meaning you can use it more than just once, okay? Now, one very important thing to understand is the more properties you get, it may be harder to use an FHA loan in the future. So if you had maybe 6 properties in your personal name now and then attempted to use an FHA loan, for all intents and purposes, it may be slightly more difficult. However, for your first purchase, it's a great opportunity for you to move in to one of the strategies that we're going to talk about next. But before we get into the strategies, we have to talk about prep work. How do you prepare to use this loan? So first and foremost, guys, you have to talk to a lender. You have to go to an FHA approved lender, all right? Somebody who can actually issue out these FHA loans. Now, when you speak to them, they're going to ask for some information from you. Obviously, the Social Security number so they can run your credit report, your income, verification of income, and things of that nature. They will also need tax returns, all the good stuff associated with getting a loan. What they're going to look at is all the loan products that they can provide you. So when you go to them, you want to make sure that you're speaking specifically about the FHA loan, or another video for another time, there might be other loan products with even less down payment. So once you speak to a lender and you get the blessing for your FHA loan, then you'll understand exactly how much you're qualified for. So 3.5% down sounds great, but you may only be approved for a $100,000 home, so you don't need to be looking at a $200,000 property. All right, fair enough. Now, after you get the FHA loan all pre-approved and ready to go, now we got to find you a realtor who understands the upcoming strategies. And as you guys know, we help here on Military Cashflow you identify a realtor that is investor savvy in your area if you guys are having issues with that. So feel free to reach out to us directly and we can point you in the right direction. Now, once you have the realtor that understands exactly what you're looking for and you have the pre-approval letter in hand, the next thing you're going to want to do is make sure that you actually have the funds for the down payment. Now, we can argue what comes first, the chicken or the egg in this case, but let's not just think about the 3.5% down payment. You also have closing costs associated with every purchase. Due to some recent events in our lives here in 2020, the reserve requirements for many of our loans have increased, okay? So when you go to the closing table and you're ready to purchase a property, you bring the down payment, but you're also going to bring some escrow payments, which would be some of your insurance, as well as your taxes that are going to be prorated in advance. So you may pay 6 months worth of insurance, 6 months worth of taxes, all upfront, and that's brought to closing. Well, as I mentioned, due to some of the recent activities, these reserve requirements have recently increased to closer to 12 months worth of reserves. So that substantial difference there essentially is saying that closing costs have doubled, for lack of better terms. Now, there's a lot of other fees associated with closing, but just understand that you need to be prepared to have a little bit more funds when you go to the closing table. Now, before we go any further, secret little tip here, if you guys don't have it, ask your realtor to negotiate for some closing costs paid by the seller. That's a nice way where you can walk away with literally only the 3.5% requirement. And there's even some advanced strategies to help you get that covered as well, which we'll discuss in another video. But now, let's get to the 2 strategies that you've all been waiting for. Strategy number 1 is the almighty house hack. All right, now a house hack can actually work a few different ways. Now, what is a house hack? Essentially is wherever your primary residence is, you rent out a portion of it to generate income. Now, the most popular way that people think of is the multifamily, the 2 to 4 units, right? It makes sense. If you have a duplex, a triplex, or a quad, you simply stay in one unit and you rent out the others. However, it can also work with single family. With a single family rental, as long as you have more than just one room, and truly if you want to be creative, as long as you have an additional couch or even a blow-up bed, you can rent out some of that extra space to roommates, right? To roommates, colleagues, fellow students if you're in student housing, work colleagues, whatever the case is. You can even find your roommates off of Craigslist. Just screen them a little bit, But nonetheless, the point is you want to make sure that you're bringing in income from the property. And then 2 to 4 units, yes, you can still do it within your own unit. You can rent out additional rooms, but you can also rent out the additional units. Now, the way that house hacking works is the intent is to reduce your monthly obligation, your monthly payment, as much as possible, if not eliminated completely. So how do you figure that out? You have the beautiful FHA loan, you know the intent is to house hack, but how do you figure out exactly what you need to charge or what you're going to end up paying in the long run? Well, it all starts with your debt obligation, your monthly mortgage payment. And when we do that, we're going to look at the PITI payment, right? Your principal, interest, which make up your mortgage payment, then your taxes and your insurance. And when you pay every month, all 4 of those are going into consideration. So you want to make sure that you're looking at that entire payment. And so for an example, let's just say it's $1,000 a month. Now you want to look at what type of income are you actually going to be producing, whether you're renting out the rooms or you're renting out the additional units. Now, once you have that income coming in, let's just say it's $900 a month from your additional rooms, okay? Your income minus your debt or your mortgage payment is going to show you what either your reduced monthly payment is or what your positive cash flow is. In that situation that we just used there, 900 income minus $1,000 monthly obligation. That means you now are living in this house for only $100 a month. You have greatly reduced, more than likely, one of your largest expenses. Now, obviously, the ideal situation is you would be positive cash flow, but regardless, house hacking is a great opportunity to use that low down payment and reduce, if not completely eliminate, your monthly obligation moving forward. It beats renting, does it not? Number 2 is the live-in flip. Now, this can happen many different ways, but we have to realize first and foremost that, again, we're using an FHA loan. It's a homeowner occupied loan, meaning you must move into it. Since it's government backed, it comes directly from the Federal Housing Administration. The condition of the home when you buy it, it has to be livable, right? It cannot be used on an investment property. So if you go up to a home that has potentially just ripped down to the studs and you're trying to go in there and use an FHA loan, probably not going to happen. Hint, hint, there's something called an FHA 203K. Again, another video, but that's a possibility where you can get the rehab or the renovation costs thrown in on top of that loan, and maybe you could buy the property that's ripped down to the studs. But back to this FHA, right? What we're talking about today. You want to make sure that it's livable. And so when you go through those inspections and that appraiser goes out there, they're going to report anything that they feel may be a red flag, right, to the loan provider. And the loan provider has to get it approved through the FHA to say that, yes, this home is good to go. Okay, so keep that in mind. So when you're searching for homes to do the live and flip, you want to make sure that, yeah, I'm getting that lower value, but it has to be livable. And with the intent that you're going to put in some work and it's going to be, a higher value. So where do you look? So maybe foreclosures. Now, foreclosures are on market. You can't really negotiate for repairs and things of that nature because they're typically bank owned, but some of them are really not in bad shape. They're not, right? Sometimes they're in decent shape and you can go in, use an FHA loan and start the flip. Or maybe for sale by owner, right? If you do it for sale by owner, a lot of times you can get the property a little bit under market value because that owner doesn't have to pay realtor fees, doesn't have to pay, all the other stuff as far as marketing and getting it on the market, staging it, cleaning it, so forth and so on, right? You can negotiate a little bit for that. Another option could be working directly with the wholesaler. Ultimately, as long as you're pre-approved and you're ready to move forward and close, you can be very creative about where you source it from. Now, even if you can't find this really below value property, potentially you can negotiate extremely aggressively and try to build in a little bit of equity on the property. But more than likely, it's not going to be enough for you to truly go in and add that value that you want for a forced appreciation, okay? Now, another thing to consider is, are you in a market or are you in a gentrifying area where over the next few years, the market truly will appreciate? Little bit of a skeptical approach, right? Because you pretty much have to hope it. You can't guarantee that the market is going to increase in value, but that's another way where you can add value, which is that second bullet, right? Add value, guys. You have to be able to go in there, whether it's replacing the floors, adding that paint, replacing the kitchen, whatever the case is, you have to be able to add value because that is where the profit margin gets built in. You didn't put a hefty down payment. You only put 3.5%. So where else are you creating that equity from, right? You have to add value. Now, ideally, by you living in the property yourself, hopefully either you're doing it or you're doing a portion of it or your roommates are doing it or whatever the case may be, right? Where you're kind of leveraging out so you're reducing your expenses or the costs to add that value. But ultimately, just understand that as long as you're living in it and doing it, you're able to buy this property for a very low price, that 3.5% down, instead of a 20% down for another flip, or borrowing hard money and paying high points, et cetera, and so forth for a flip. And the last little tip would be you live in it for 2 years while you're fixing it. It helps you out in a few different ways. 2 years, you can slow it down. You don't have to rush. You don't have to take the next 3 months to get this property in pristine condition. You just do a little bit over time. But why 2 years? Well, there's a beautiful little tax code that says your primary residence or a property that you've lived in for 2 out of the 5 previous years, you can then sell it with no capital gains tax up to a certain point of value, right? So if you sold the property and you made $1 million profit margin, unfortunately, all of that would not be covered or avoided of the capital gains tax, right? Now, but if you made a nice hefty profit of 75 to 100, 150,000, yep, all of it can be protected. Now, please check with your CPA to make sure that you understand where your profit margins are that can be covered by the capital gains tax. But guys, if you have a W-2 job, if you have something else that's high taxed income, and then you throw in a short-term capital gains tax on top of that, you're going to be hit pretty hard. So living in it for 2 years can be extremely beneficial if the profit margins are there. So how do you figure out those profit margins? It's pretty simple. It's pretty simple. You have to start with what the projected value could be on the property. We call it after repair value, ARV. Now, keep this in mind. It's a little difficult to get this number accurate, right? If you buy today and you ran the numbers for an ARV or after repair value, that would be for today. But what we just say, you're probably going to live in it for 2 years. Right? So in order to try to predict the 2 years, you want to get the ARV of today, and then you want to add in or adjust for the appreciation of that property. So you can get an idea of what that property will be worth in the next 2 years, right? Keep that in mind. Next, you're going to take your repair cost. How much are you going to put in? This is the part where we talked about, yeah, you can absolutely bring in some contractors and have them do the work, but ideally you would want to be able to do it yourself or find a way to truly reduce those costs. Then also you want to subtract, what did you buy it for? Okay. What did you actually pay for it? Because when it's time to sell, you're still going to have to pay off your remaining mortgage balance. All right. So yes, 2 years, let's say you bought it at $150,000. You're not going to necessarily owe $150,000. But let's be honest, these loans are 30-year fixed loans. They're amortized over 30 years. Even after 2 years, you may have taken off maybe $5,000 worth of equity. It's not much, right? So for all intents and purposes, when you're running the numbers, just consider purchase price plus the repairs, and then you want to subtract that from the ARV, which is going to determine your potential profits. All right, guys. We went over the 2 key strategies, but guess what? What if you just got both of them and put them together and made a baby? What if you did a house hack live-in flip? Yeah. What if you, say it's a single family home or a home with a detached mother-in-law suite? It's irrelevant. What you're doing is you're creating income for the time that you're living there. Okay. You're renting out some space and you're creating income while you're living there. Then you're adding value. So when it's time to sell, and you're living in it for 2 years, right? So when it's time to sell one, your monthly obligation was either reduced or completely wiped out to where you were making money. And then you just profited and you recovered or you protected those capital gains. That's a double whammy. That's what we like to do, guys. We like to get extremely creative with all of these beautiful loans that we qualify for, where we can keep as much of our hard-earned money in our pockets as possible and really elevate our returns. And that's it, guys. That's how you invest with an FHA loan. If you guys like the content, please hit that thumbs up button. You got to subscribe so you can get more of this fresh content, and hit the notifications bell so you know right when we drop it. Leave a comment below. Let us know what you thought. If there's any other topics that you want to have discussed, please let us know. Don't hesitate. Reach out. If you guys listen on a podcast, you already know, 5 stars, please, and thank you. And then be sure to check out our military Cashflow Facebook group. We now have a little over 600 servicemen and women that are at all stages of their investment journey. Some at the beginning, some have massive portfolios. We have insurance provider, credit repair specialists, lenders, everything within that community. So please get in there, add value, ask questions, and let's grow together.